Hi everyone. So I wanted to work through a problem in chapter 11. I think this is really the key problem out of this chapter. So this is what you need to take away from really chapter 11. There's a lot of detail, but the indirect method for the statement of cash flows is really critical. So this is problem P1157A on page 645. So pause the video, open your book to that problem and read through it carefully, okay? And so I'll start working on it here. Requirement one, they want us to prepare an income statement for the period ended December 31st, 2018. So, you're gonna do your title, Coleman Motors, Inc., income statement, year ended December 31st, 2018, okay? And we're just gonna have our revenue, our cost of goods sold, our salary expense, give us depreciation expense. What else do we have here? Rent expense, income tax expense, so a bunch of expenses, and net income. So let me go back up here and grab the numbers. So revenue, I see that they have 426,000. Cost of goods sold, I need to calculate. So they tell me that the company uses first in, first out FIFO to account for inventory. And we sold 6 cars, so first in, first out is going to be 175,000 plus 47. This is going to be 222,000, and that's just the 175,000 for the 5 cars, and 47,000 for the one. Okay. Oops. Sales expense, salary expense, 90,000. Depreciation expense is 140,000 divided by 5, which is 28,000. Right, just to make sure the math there makes sense. 140,000 divided by 5. Rent expense is 19,000. Income tax expense is 14,000. So net income when all is said and done should be 53,000, right? So if we put a line underneath that, that's what our net income should be. So that's just the basic income statement that they ask from requirement 1 for us. Okay, so hopefully that makes sense. Requirement 2 is our balance sheet. So this is going to be, just really copy this to here, except this is now going to be called a balance sheet, and it's not year ended, it's a specific date, so we're going to get rid of that. All right, so let's just go down and do current assets. So cash, you will need to calculate this. So you have to look at the 350,000 that they issued in stock. So here, let me do the math here. Down at the bottom. So this is going to be 350,000 that they issue in stock. Okay, they spend 140,000 on equipment. They spend 175,000 on inventory. They pay rent of 19,000. There's another 197,400 on inventory. They get cash sales of $383,400. They pay salaries of $85,000. They pay taxes of $14,000. And they pay out dividends of $29,000. So if you do all the math, our cash is $74,000. Okay, so hopefully that makes sense there. So $74,000 is my cash. Accounts receivable. I'm just going to shorthand accounts receivable AR. This is going to be $42,600. It's just 10% of $426,000. Okay. And inventory, leftover, we have 5 pieces of inventory. They were $47,000 each. So our inventory is $235,000. So current assets, keep it at this for now. Zoom in a little. So current assets are going to be $351,600. Okay. Long-term assets, we've got property, plant, and equipment, PP&E, of $140,000. We've got accumulated depreciation of $28,000. So our net PP&E here is going to be $112,000. So if I take my current assets and my long-term assets, hold on here, let me do this so hopefully I can fit more on here. Okay, my current assets and my long-term assets, so my total assets are equal to $463,600. Right, that's just this number, 112 for long-term assets plus the current assets, 351,600 equals that right there. Okay. Then we can over here do liabilities. So for current liabilities, I'm going to have account payable of $84,600. I just got that by taking $282,000 minus $197,400. And, well, I don't really want that underline. And salary payable, $5,000. So total current liabilities, $89,600. And there are no long-term liabilities in this case. So we go straight to stockholders' equity. So common stock, $350,000. Retained earnings. So retained earnings here is $24,000. It's just $53,000 minus $29,000. So total stockholders' equity equals $374,000. And if you add everything together, total liabilities and stockholders' equity, we should get $463,600. Right, which makes sense. Your total assets equals your total liabilities plus stockholders' equity. Okay, so that should all be review, but all of this information is necessary for us now to prepare the indirect method statement of cash flows, which is requirement 3. Okay, so this one I'm going to borrow this title here because statement of cash flows, like the income statement, is for a period. So this is going to be statement of cash flows. And it is year-ended, so that's fine. Okay, so I'm going to start with cash flows. Whoops, cash flows from operating activities. So here's what we do for the indirect method of cash flows. We're going to start with net income. So we have that up in requirement 1, 53,000. Now we're going to do adjustments to reconcile net income to cash. Okay, that's the way I think about it. So first we have our net income. So what are some of these adjustments that we need to do? Well, we have depreciation expense. Remember, depreciation expense is an accounting trick. It's not really a cash thing, right? So we add that back to net income because depreciation expense affected net income, but it did not affect cash. So we're going to add that back. Now we have to do increases and decreases. So in this problem, all we have are increases in our assets, and in this case, it's increases in our accounts receivable and inventory, and then we have increases in our liabilities, in this case, accounts payable and salary payable. So an increase in accounts receivable of 42,600. So that is a drain on cash. So I'm going to put that in parentheses. That's going to reduce my cash versus net income amount. An increase in inventory, likewise. So any increases in current assets are going to be a negative, okay, or cash out type of scenario when you're adjusting your net income. An increase in accounts payable means we didn't pay an account payable. Whoops. Wow, okay. Why am I still getting capitals? Let me just do this, accounts payable. So this is, we add it to our net income to get to cash, and increase in salary payable. We're going to add it to net income to get cash. So when we look at all of these adjustments, okay, and sum these all up, we get that 160,000 has to be decreased for cash purposes from net income. Okay, so this is just the summing up of these various adjustments. Okay, so if I look here, my net cash used in this case for operating activities is 107. Got it? So if this does not make sense to you right here, please go back through this chapter and reread this. This part is very key. This is what you need to really take away from chapter 11, is the indirect method of cash flow. Okay, you will work a problem also for direct methods of cash flows. I think if you can master the indirect method of cash flows, the direct method of cash flows is pretty straightforward, and it's not really used much in the real world. The indirect method of cash flows is pretty much exclusively, I've personally never seen the direct method of cash flows used in the real world, only the indirect method. Okay, so that was your cash flows from operating activities. Now we're going to go to cash flows from investing activities. And if you remember, this is your change in long-term assets. So in this case, we purchased some equipment. And obviously, if you're buying equipment, that's cash going out. And that was the only thing we actually did. So net cash used for investing activities in our situation was just 140,000. So that cash went out. Finally, we have cash flows from financing activities. And in this case, we issued common stock. So 350,000 came in. We paid a dividend. So that was cash going out, 29,000. So net cash, in this case provided, because we have a positive, by financing activities is 321,000. And so our effect, so we're starting with our net income, right? So the cash flows from operating activities, this is the main difference. So these two are going to be the same whether you use the direct or indirect method. Up here, this cash flow from operating activities, this is what's going to differ when you're doing the indirect method, because you're getting to this number indirectly. You're starting with net income, and then you're adjusting net income based on these non-cash events, okay? And so that's what you're getting, that's how you're getting to your actual cash. So then for the total change throughout the year, you need to sum up what happened with cash from operating activities, what happened with cash from investing activities, and what happened with cash from financing activities. Okay, and if I sum those up, then I get a net increase in cash of 74,000. Oops, 74,000. Okay, and so my cash balance at the beginning of the year, 1/1/18, was 0. I just started the company, right? My cash balance at the end of the year was my beginning plus my change, which in this case, 74,000, right? So that is the indirect method statement of cash flows. This is the key takeaway from this chapter. So please make sure you do not leave this chapter without clearly understanding this. Okay, so as always, feel free to reach out with any questions. Again, you'll have a problem as well to do the direct method. I think the direct method is much more straightforward, especially if you've mastered this. And remember, for the direct method, these parts for indirect and direct method, cash flows from investing activities and cash flows from financing activities are the same. It's only this cash flows from operating activities that differs. Okay, so good luck.